Before we begin, please note that I am not a licensed insurance agent or financial advisor. This video is for informational and educational purposes only and should not be considered legal or financial advice. The world of insurance is complex and varies significantly by state and provider. Always consult with a qualified and licensed professional to discuss your individual needs and to review your specific policy documents before making any decisions. Picture this. A guy named Mark saves up for months to buy a brand new set of 20-inch custom wheels and high-performance tires for his car. We're talking $3,000 easy. He's meticulous. He loves his car. It's his pride and joy. And he's a responsible driver. He has what he calls full coverage insurance. He pays his premium on time every single month. He feels protected, secure. One rainy Tuesday afternoon, he's sitting at a red light, minding his own business when bam, a distracted driver slams into the back of him, pushing his car into the intersection where another car clips his front passenger side. It's a mess. Thankfully, nobody is seriously hurt, but Mark's car is mangled. And those beautiful brand new custom wheels? One is cracked in half, another is bent beyond repair. They're toast. But Mark isn't panicking. He thinks, okay, this is what I have insurance for. The other driver was at fault, and even if there's an issue, my own full coverage policy will take care of it. That's what collision coverage is for, right? So the tow truck comes, the claim is filed, and a week later, the insurance adjuster calls him. The news is not good. The adjuster says, Mr. Johnson, we've assessed the damages. We're covering the repairs to your bumper, your quarter panel, and the alignment. But we can't cover the replacement of your custom wheels and tires. Mark is stunned. He says, what do you mean? I have full coverage. I have a $500 deductible for collision. The wheels were destroyed in the accident. You have to cover them. And then the adjuster delivers the line that costs American drivers millions of dollars every single year. A line that is buried deep in the fine print of almost every standard auto policy in the country. He says, I'm sorry, sir, but your policy only covers the factory-installed or equivalent parts of the vehicle. Any custom equipment, anything aftermarket, isn't included in your standard coverage. You needed a special endorsement for that. An endorsement. That one word cost Mark $3,000 out of his own pocket. $3,000 he thought was protected. $3,000 that vanished because of a single paragraph on a page he never even knew existed in his policy. This story isn't a rare exception. It happens every single day in every state. And it's not just about custom wheels. It's about sound systems, ride-sharing, food delivery, rental car reimbursement, and even the gap between what you owe on your car loan and what the car is actually worth. There is a giant, dangerous myth that has been sold to the American public, and that is the myth of full coverage. I'm here to tell you that full coverage car insurance does not exist. It's a marketing term. It's slang. It is not a real insurance product. And believing in it is like believing a standard umbrella will keep you dry in a hurricane. It gives you a false sense of security that will get shattered the moment you actually need it most. So what's the truth? The truth is your car insurance policy is not a blanket that protects everything. It's a base package. Think of it like a combo meal at a fast food restaurant. You get the burger, the fries, and the drink. That's your standard liability, your collision, and your comprehensive coverage. That's what most people call full coverage. But what if you want extra cheese? What if you want to upgrade to a larger size? What if you want to add a milkshake? You can't just assume it's included in the combo. You have to specifically ask for it. You have to add it to your order. In the world of insurance, those add-ons, those special requests that customize your policy to fit your actual life, are called endorsements. An endorsement, sometimes called a rider, is simply a legal amendment. It's an addition to your standard insurance contract that changes the original terms. It can add coverage for things that are normally excluded, like Mark's custom wheels. It can broaden your protection, like giving you rental car coverage while your car is in the shop. It can even be used to exclude coverage for certain things to lower your premium. It is the single most important part of your policy that almost nobody ever talks about. Your insurance company's website probably buries it. Your agent might have glossed over it in the 5 minutes they spent setting up your policy. But understanding endorsements is the difference between financial security and financial disaster. It's the difference between being made whole after an accident and being handed a bill for thousands of dollars you weren't expecting. So, why don't standard policies just cover everything? Why do we even need these complicated add-ons? It's simple: cost. Insurance companies build their standard policies to cover the average driver with a stock vehicle used for normal purposes, like commuting to work and getting groceries. They calculate the risk and price for that specific scenario. But let's be honest, who is really average? Do you drive for Uber or Lyft on the weekends? Your standard policy probably won't cover you while you have the app on. That's a gap. Do you have a loan or a lease on your car? If you total it, the insurance company will pay you what the car is worth today, not what you still owe the bank. That could be a gap of thousands of dollars. Did you install a $5,000 audio system? That's a gap. Do you use your personal truck for a side business in construction? Huge gap. Your life is unique. Your car is unique. Your risks are unique. A one-size-fits-all insurance policy is actually a one-size-fits-none policy. It's designed to be modified. It's built to be customized with endorsements. The insurance company isn't trying to cheat you by not including everything from the start. They're trying to offer a baseline product that you are then responsible for tailoring to your specific needs. The problem is, nobody ever tells you that you're the tailor. Over the course of this presentation, we are going to pull back the curtain on this critical topic. We are going to demystify the jargon and arm you with the knowledge you need to protect yourself. You will learn about the most common, most vital endorsements that you need to know about. We'll cover everything from custom parts and equipment coverage, which would have saved Mark, to rideshare coverage for Uber and Lyft drivers. We'll break down gap insurance, which is an absolute must-have if you have a car loan. We'll talk about rental reimbursement, roadside assistance, and even something called new car replacement coverage, which can be an absolute lifesaver. My goal is simple. By the time you finish this video, you will be able to look at your own insurance policy with a new set of eyes. You will be able to spot the dangerous gaps in your coverage. And you will be able to have an intelligent, informed conversation with your insurance agent to build a policy that actually protects your car, your finances, and your peace of mind. You won't be buying a vague promise of full coverage anymore. You will be building a personalized shield of protection, one endorsement at a time. So let's get started. Think of your standard car insurance policy like a smartphone right out of the box. It has the essentials. It can make calls, send texts, and take basic photos. It works. But is it truly useful for your specific life? Not yet. You haven't downloaded any apps. You haven't customized the settings. You haven't made it yours. Car insurance endorsements are the apps for your policy. They are the custom settings. They are the specific, powerful tools you add to that basic, out-of-the-box policy to make it perfectly suited to your car, your finances, and your life. An endorsement, sometimes called a rider, is simply a legal amendment to your standard insurance contract. It's a formal change that can do one of three things. It can add coverage you don't have, it can remove coverage you don't need, or it can clarify or change the existing terms of the policy. It's the mechanism that allows insurance to stop being a one-size-fits-all product and become a tailored suit of armor. Why is this so important? Because no two drivers are the same. A 19-year-old college student driving a 15-year-old Honda Civic to class has a completely different set of risks than a 45-year-old contractor driving a brand new, $50,000 Ford F-150 loaded with expensive tools. A standard policy treats them far too similarly. The student doesn't need coverage for a massive loan, and the contractor absolutely needs coverage for his specialized equipment. Endorsements are what bridge that gap. They allow you to pay for only the protection you actually need and ensure you're not left financially exposed in a way that's unique to your situation. So let's stop talking in theory and dive into the most critical endorsements you need to know about. We're going to start with an absolute giant, one that can mean the difference between a minor inconvenience and total financial ruin. I'm talking about gap insurance. To understand why gap insurance is so vital, you have to understand a brutal financial truth about new cars. The second you drive a new car off the dealer's lot, its value plummets. This isn't an opinion. It's a fact called depreciation. It can lose 10, 20, even 30% of its value in the first year alone. Now let's paint a picture. You just bought your dream car. Cost you $40,000. You were so excited you only put down a small down payment, maybe $2,000, and you financed the remaining $38,000 over a long 72-month loan to keep the payments low. You feel great. Life is good. 2 months later, disaster strikes. A distracted driver runs a red light and T-bones you. The car is a twisted wreck, completely totaled. Thankfully, you're okay, but the car is gone. You call your insurance company, assuming your full coverage policy will handle it. And they do. They assess the car's value and write you a check. But here's the kick in the teeth. They don't write you a check for $40,000 what you paid. They write you a check for the car's actual cash value, or ACV. That's what the car was worth the second before the crash. Thanks to that instant depreciation, your 2-month-old car is now only worth $33,000. So the insurance company gives you a check for $33,000. But wait, you still have that loan. You still owe the bank nearly the full $38,000 you borrowed. You are now in a nightmare scenario. You have to give the entire $33,000 check to the bank, and you still owe them another $5,000. Let that sink in. You are left with no car, and a $5,000 bill for a vehicle that no longer exists. You are literally paying for scrap metal. This is the gap. The devastating financial canyon between what your car is worth and what you still owe on your loan or lease. And this is exactly what gap insurance is designed to prevent. If you had a gap insurance endorsement on your policy, the story would have a very different ending. Your primary insurance would pay the $33,000 actual cash value. Then your gap coverage would kick in and pay the remaining $5,000 difference directly to the lender. Poof! The loan is gone. You walk away clean with no car but also no debt. You can now take a deep breath and focus on finding a new vehicle, instead of figuring out how to pay off a ghost. So, who needs gap insurance? You should seriously consider it if you 1. Made a small down payment on your car, less than 20%. 2. Financed your car for 60 months or longer. The longer the loan, the longer it takes for your payments to catch up with the car's depreciation. 3. Leased a vehicle. Leases almost always require it for this exact reason. And 4. Bought a car that depreciates faster than average, like many luxury or high-performance models. Gap insurance is the hero for your loan. But what about replacing the car itself? This brings us to another, closely related hero endorsement: new car replacement coverage. Let's go back to our story but change it slightly. Let's say you were a savvy car buyer. You put down a huge 30% down payment, so you don't have a gap. Your $40,000 car gets totaled a year later. Its actual cash value is now, say, $31,000. You owe the bank only $25,000. So, your insurance gives you the $31,000 check. You pay off the bank and you're left with $6,000 in your pocket. You're not in debt, which is great. But now you have a new problem. You have $6,000 and you need to buy a new car. The exact same model you just lost now costs $42,000 because prices went up a bit. You're short by $36,000. You loved your car and now you're forced to either take out a massive new loan, drain your savings, or settle for a much older, less reliable, or less safe vehicle. Your standard policy made you whole, based on the value of your used car, but it didn't make you whole in terms of your lifestyle and transportation. This is where the new car replacement endorsement rides to the rescue. With this coverage, if your new car is totaled within a specific time frame, usually the first 1 or 2 years of ownership, and under a certain mileage limit like 24,000 miles, the insurance company won't just give you the depreciated value. They will pay to replace it with a brand new car of the same make and model. Not a check for a used one, a brand new car. So in our scenario, instead of getting a check for $31,000, your policy would pay out the full $42,000 needed to put you back in the driver's seat of the exact same model you had, fresh from the factory. It's an incredibly powerful upgrade that protects you from depreciation in a different way than gap insurance does. It's crucial to understand the difference. Let me say it clearly. Gap insurance protects your lender. New car replacement protects you. Gap pays off your loan so you're not in debt. New car replacement gives you the funds to buy a brand new vehicle. They are not the same thing, and depending on your down payment and loan, you might even want both for the ultimate peace of mind in those first couple of years. These two endorsements alone transform a basic policy from a simple safety net into a powerful financial tool that accounts for the modern realities of car buying and depreciation. They are perfect examples of how you can analyze your specific situation, your loan, your down payment, the age of your car, and add a specific app to your policy to cover a very real and potentially very expensive risk. But we are just scratching the surface. What about the $2,500 custom wheels and stereo system you just installed? What happens if you get into an accident while driving for a rideshare service? What if your pet is injured in a crash? Standard policies often cover none of this, but there are endorsements for all of it. And in the next part, we're going to uncover the endorsements that protect your custom gear, your side hustle, and even your furry family members. Let's start with your pride and joy. That car you've poured your heart, soul, and a significant amount of your paycheck into. You didn't just buy a car. You crafted an experience. You swapped out the stock wheels for a set of stunning lightweight alloys. You replaced the factory stereo with a sound system that makes you feel like you're in the front row of a concert. Maybe you added a custom paint job, a vinyl wrap, a spoiler, or even performance-enhancing engine modifications. You've spent $2,500, maybe $10,000 turning your vehicle from a standard model into something that is uniquely yours. Now, imagine the gut-wrenching sound of a fender bender. It's not a terrible crash, everyone is okay. But the front end is crumpled. Your custom grille is destroyed, one of those expensive headlights is shattered, and the bumper with that unique paint is a complete loss. You file a claim, relieved that you have full coverage. The adjuster comes out, assesses the damage, and a few days later you get the estimate. And your heart sinks. They've agreed to replace your $2,500 wheel with a $400 factory rim. They're offering to put a basic stock radio back in your dash, not the $2,000 touchscreen navigation and sound system you installed. That $1,000 custom paint job on the bumper? They're covering the cost to spray it with a standard factory color. Why? Because a standard auto insurance policy is designed to do one thing: return your car to its factory condition. It insures the vehicle as it rolled off the assembly line. Every dollar you invested in personalization is, in their eyes, completely invisible. It doesn't exist. All that money, all that passion gone in an instant. This is where the first powerhouse endorsement comes into play. Custom Parts and Equipment Coverage, or CPE. This is your financial shield for the personality of your car. By adding this endorsement, you are officially telling your insurance company, hey, my car is more than just stock. I've invested in it, and I want those investments protected. Here's how it works. You and your insurer agree on a value for your custom parts, say $5,000. This amount is added to your policy, and your premium increases slightly, often by just a few dollars a month. But now, if you get into that same accident, the insurance company is obligated to pay for the repair or replacement of your custom parts, up to that agreed-upon limit. That $2,500 wheel gets replaced with another $2,500 wheel. That high-end sound system is covered. The custom paint is restored. CPE coverage ensures that you get your whole car back, not just the factory shell. If you have so much as a set of aftermarket rims on your car, you need to call your agent and ask about this. It is one of the most overlooked and financially critical endorsements for anyone who takes pride in their ride. Now let's shift gears. The way we use our cars has fundamentally changed in the last decade. Millions of Americans are using their personal vehicles to earn extra income, driving for Uber or Lyft, delivering for DoorDash, Grubhub, or Instacart. It's the modern side hustle, and it has created one of the biggest and most dangerous insurance gaps in the country. Here's the scenario. You finish your day job, you flip on the Uber app, and you start driving around waiting for a ride request to come in. You're technically working. Your app is on, you're available for hire. While waiting, you glance down at your phone for a second, and you rear-end someone at a stoplight. It's a minor accident, but it's clearly your fault. You do the responsible thing, exchange information, and call your personal auto insurance company to file a claim. The agent on the phone asks you a few standard questions, including the devastatingly simple, "What were you doing at the time of the accident?" You answer honestly, "I was driving for Uber, waiting for a passenger." And then you hear the words that no one ever wants to hear. "I'm sorry, but your claim is denied. Your policy has a commercial use exclusion." Almost every single personal auto policy in the United States contains this clause. It explicitly states that the policy will not provide any coverage if the vehicle is being used for commercial purposes, like delivering goods or transporting passengers for a fee. The moment you turn on that app, your personal insurance vanishes. You are, for all intents and purposes, driving uninsured. But wait, you say, doesn't Uber or Lyft have insurance for their drivers? Yes, they do. But here's the critical detail most drivers don't know. That coverage is tiered, and it depends on what period of driving you're in. Period 1 is when you have the app on and are waiting for a ride or delivery request. This is the danger zone. During this period, the company's insurance is extremely limited. It typically only provides liability coverage, meaning it pays for damage you cause to others, and the limits are often just the state minimums, which can be shockingly low. More importantly, it provides absolutely zero coverage for damage to your own car. So in our scenario where you rear-ended someone, the TNC's insurance might cover the other person's car. but you are completely on your own for your repairs. Periods 2 and 3 are when you've accepted a request and are either on your way to pick someone up or have them in the car. During these periods, the company's insurance is usually much more robust, often with up to $1 million in liability coverage and some coverage for your own vehicle, though usually with a high deductible. The solution to that terrifying gap in period 1 is a simple endorsement called a rideshare endorsement, or sometimes Transportation Network Company (TNC) coverage. This endorsement plugs the hole. It extends your personal auto policy's protections to cover you during period 1. With this endorsement, when you have that accident while waiting for a passenger, your own collision coverage kicks in to fix your car. Your own liability limits, which are hopefully much higher than the state minimum, are there to protect you. It transforms your personal policy, allowing it to work in harmony with the company's insurance, ensuring you are never left without a safety net. For the peace of mind it offers, a rideshare endorsement is often incredibly affordable, sometimes adding just $10 or $20 to your monthly premium. Driving for a rideshare or delivery service without it is one of the biggest financial gambles you can take. Finally, let's talk about a member of your family that the insurance company doesn't automatically recognize: your pet. For millions of us, our dog isn't just a pet, they're our co-pilot. They ride with us everywhere. But what happens if you're in an accident and your furry best friend gets hurt? You're okay, the car is damaged but fixable, but your dog has a broken leg. You rush to the emergency vet, and they tell you the surgery and care will cost $2,000. You don't hesitate, you do anything for them. But as you hand over your credit card, you wonder, will my car insurance help with this? The answer, under a standard policy, is a flat, heartbreaking no. Your auto insurance covers liability for people and damage to property. The car. It sees your pet, a living, breathing member of your family, as nothing more than personal property, like a laptop sitting on the passenger seat, which is also not covered. This is where a small but incredibly valuable endorsement called pet injury coverage comes in. This add-on provides a specific amount of coverage, typically between $1,000 and $2,000, to pay for veterinary bills if your pet is injured in a covered car accident. Some policies will even provide a death benefit if the worst should happen, helping to cover cremation or burial costs. It's an endorsement born of compassion. It recognizes that the bond we have with our animals is real, and that the cost of caring for them after a traumatic event shouldn't be an added financial burden. The cost for this coverage is almost negligible, sometimes just a few dollars for the entire year, and some of the best insurance companies are now even including it automatically with collision coverage. It's a small price to pay to ensure that in the chaos and fear of an accident, you can focus on what really matters: getting your best friend the care they need. Now let's shift our focus from protecting the precious cargo inside your car to protecting the car itself, specifically your financial investment in it. This is where we get into some of the most powerful and frankly most misunderstood endorsements available. These are the ones that can literally save you from financial ruin after a catastrophic accident. Let's start with a scenario. Picture this. You've just bought your dream car. It's a brand new $50,000 SUV. You saved for the down payment, you got a good interest rate, and you drove it off the dealership lot feeling on top of the world. The smell of new car leather is still fresh. But here's a brutal financial truth that most people don't want to think about. The moment those 4 brand new tires hit the public street, your car's value plummeted. This isn't an opinion. It's called depreciation, and it's a new car's worst enemy. In the first year alone, a new car can lose 20% or more of its value. So 1 week after buying your dream SUV, you're stopped at a red light and bam, someone plows into you from behind. The car is a twisted wreck. The body shop and your insurance adjuster both agree it's a total loss. You're okay, thankfully, but your brand new car is gone. Now you might think, no problem, I have full coverage. My insurance will just buy me a new one, right? Wrong. This is one of the most painful lessons a car owner can learn. Your standard collision coverage doesn't pay you what you paid for the car. It pays you the car's actual cash value, or ACV, at the moment of the accident. That $50,000 SUV you bought last week? Its ACV after just 1 week of depreciation might only be $46,000. So the insurance company cuts you a check for $46 grand. You've just lost $4,000, you no longer have a car, and you're left scrambling to figure out how to buy another one without taking a huge financial hit. This is the exact nightmare scenario that the new car replacement endorsement is designed to prevent. Think of it as depreciation insurance. With this endorsement added to your policy, if your new car is totaled within a specific time frame, Usually the first 1 to 2 years of ownership and under a certain mileage like 24,000 miles, the insurance company does something magical. They don't just pay you the depreciated actual cash value. They pay you the amount you would need to go out and buy the exact same make and model brand new. Some policies will even pay for a model that's 1 year newer if yours is no longer in production. Suddenly, that $4,000 loss evaporates. You're made whole. You can go back to the dealership and get a true replacement for what you lost, not just a check for what it was worth. This endorsement isn't for everyone. It only applies to new vehicles, but if you are buying new, it is an absolute must consider. Now, let's explore a related but distinctly different financial trap. This one is called being upside down or underwater on your car loan, and it's terrifyingly common. For this, we need to add another layer to our story: the car loan. Let's go back to that $50,000 SUV. This time, let's say you put 10% down, so $5,000, and you finance the remaining $45,000. You get a common 72-month loan to keep the payments manageable. 1 year goes by. You've been making your payments diligently. You've paid about $6,000 towards your loan, so you now owe the bank $39,000. But remember our old friend, depreciation? It's been working against you that entire year. Your 1-year-old SUV, which you still owe $39,000 on, now only has an actual cash value of $35,000. This is the gap. You owe $4,000 more than the car is actually worth. Now disaster strikes. Your car is totaled. Your collision coverage kicks in and your insurer sends a check for the ACV, $35,000, directly to your lender. The bank gets its money, but here's the gut punch. You still owe them $4,000. You are now legally on the hook for a $4,000 bill for a car that no longer exists. You have no vehicle and you have a massive debt. This is the financial quicksand that has trapped millions of Americans. Enter the savior: guaranteed auto protection, better known as gap insurance. This endorsement is a bridge over that financial chasm. If your car is totaled, gap insurance pays the difference, the gap, between the actual cash value of your vehicle and the amount you still owe on your loan or lease. In our scenario, it would pay that $4,000 difference directly to the lender, clearing your debt. You walk away clean. You don't get money for a new car, that's what new car replacement is for. But you're freed from the ghost of a loan for a car that's now in a scrapyard. Who needs gap insurance? Almost anyone who isn't making a massive down payment. If you put less than 20% down, you are almost certainly upside down the second you drive off the lot. If you have a long loan term, 60, 72, or even 84 months, you need it. Your payments are so small in the beginning that depreciation outruns them for years. And if you drive a lot of miles, which accelerates depreciation, you absolutely should have it. A quick pro tip: dealerships will almost always try to sell you gap coverage when you buy the car, often rolling it into your loan for a very high price. Politely decline. Adding it as an endorsement to your auto insurance policy is almost always significantly cheaper. So we have new car replacement for brand new cars, and gap insurance to cover the loan. But what if your car is, say, 3 or 4 years old? It's not new anymore, so new car replacement is off the table. But you've paid down your loan enough that you're not upside down, so gap insurance isn't necessary either. You still face a problem. If your beloved 4-year-old car gets totaled, the insurance company will give you its actual cash value. And you might discover that the ACV is only enough to buy a 7-year-old car with twice the miles. You're being forced to take a major step down in quality and reliability. For this situation, some companies offer a fantastic middle ground endorsement, often called better car replacement or newer car replacement. The names vary, but the concept is brilliant. With this coverage, if your car is totaled, the insurer won't just give you the ACV. Instead, they will pay to replace your car with one that is a model year or two newer and has fewer miles. For example, if your 2020 Honda CR-V with 60,000 miles is totaled, this endorsement could give you enough money to buy a 2021 or 2022 model with only 45,000 miles. It ensures that a total loss doesn't force you backwards. It allows you to maintain, or even slightly improve, your transportation situation without digging into your own savings. It's a way of acknowledging that your car was more than just its cash value. It was your reliable, known, and trusted vehicle, and finding an equivalent replacement on the open market for just the ACV can be incredibly difficult. These 3 endorsements, new car replacement, gap insurance, and better car replacement, are all designed to combat the harsh financial realities of depreciation and car loans. They transform a standard insurance policy from a simple repair service into a powerful tool for financial security. But financial security isn't just about the catastrophic, total loss scenarios. It's also about the immediate gut-wrenching moments, the ones that don't total your car, but still leave you stranded, stressed, and facing unexpected bills. These are the moments that disrupt your life, your schedule, and your peace of mind. And that's where our next category of endorsements comes in. These are the convenience and reality riders. They're designed to solve the logistical nightmares that pop up when your car is out of commission. Let's start with one of the most common and frankly most comforting endorsements you can get: roadside assistance. Picture this. It's late. You're driving home on a quiet stretch of road, miles from the nearest town. Suddenly, you hear that dreaded thump 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 of a flat tire. Or maybe the engine just sputters and dies. Your battery is dead. You're out of gas. You locked your keys in the car. We've all had that flash of panic. What do I do? Who do I call? How much is this going to cost me? This is precisely the moment roadside assistance coverage was built for. For a few extra dollars on your policy, sometimes as little as $5 or $10 every 6 months, you get a 24/7 lifeline. Instead of frantically searching Google for a tow truck near me and hoping you don't get price gouged by the first company that answers, you just call the number on your insurance card. They'll dispatch someone to your location for a whole menu of common problems. They can tow your car to the nearest qualified repair shop. They'll send someone to change your flat tire, as long as you have a spare. They can jumpstart a dead battery. They can bring you a few gallons of gas if you run out. They can send a locksmith if you're locked out. Now you might be thinking, I can just pay for a tow truck if I need one. And you're right, you can. But a single tow can easily cost you $100, $200, even $300 or more, depending on the distance and the time of day. A lockout service can be $75 to $150. Suddenly, that tiny premium you pay for the endorsement looks like an incredible bargain. After just one use, it has likely paid for itself for several years over. But is it always the best option? This is where we need to be smart consumers. Many people already have some form of roadside assistance and don't even know it. Some premium credit cards offer it as a perk. Your car manufacturer might have included it for the first few years of ownership. And of course, there are dedicated services like AAA. So here's the smart play. First, check if you already have it elsewhere. Read the fine print on your credit card benefits or your vehicle's warranty. Second, compare the services. Your insurance company's plan might have a limited towing distance, say 15 miles, while a premium AAA plan might offer 100 or even 200 miles. If you frequently travel long distances or live in a rural area, that difference is huge. However, for most everyday commuters, the insurance company's option is often more than enough and is seamlessly integrated into your policy. It's about choosing the right tool for your specific life, but for the vast majority of drivers, adding it to your auto policy is one of the cheapest ways to buy invaluable peace of mind. Okay, so roadside assistance gets you and your disabled car off the road. But what happens next? Your car is now at the body shop, and the mechanic gives you the news. It'll be about 10 days to get the parts and finish the repairs. 10 days? How are you getting to work tomorrow? How are the kids getting to soccer practice? How are you getting groceries? Life doesn't just stop because your car is in the shop. This is the problem that our next endorsement, rental reimbursement coverage, is designed to solve. It's also sometimes called transportation expense or loss of use coverage. The name might vary, but the purpose is the same. It helps pay for a rental car while your vehicle is being repaired after a covered claim. That's the key phrase right there. A covered claim. This isn't for when your transmission fails due to old age or you need routine maintenance. This is for when you're in an accident or your car is damaged by something your policy covers, like a hailstorm or a fallen tree, and you can't use it. Here's how it works. The coverage is usually structured with a per day limit and a per claim maximum. You might see something like $30 per day, up to a maximum of $900. This means the insurance company will reimburse you up to $30 for each day you need a rental, until the repairs are done or you hit that $900 total limit, whichever comes first. $30 a day might not get you a luxury SUV, but it will typically cover the cost of a basic, compact rental car that can get you from point A to point B. And that's the whole point. It keeps your life moving. Many insurers have direct billing relationships with major rental companies, which makes the process even smoother. You show up, they see your claim number, and you drive off with the bills being handled directly by your insurance provider. The most important decision you have to make here is choosing your daily limit. If you live in a major city where rental cars are expensive, or if you have a large family and absolutely need a minivan or an SUV to function, a $30 a day limit might not cut it. You might want to opt for a higher limit like $40, $50, or even more. The increase in your premium is usually very small, but the benefit when you actually need it is enormous. Think about it. A 10-day repair without this coverage could easily be a $400 or $500 out-of-pocket expense for a rental car. With the endorsement, it's covered. It transforms a major financial headache and logistical nightmare into a minor inconvenience. Now let's shift gears a bit. We've talked about what happens when your car is broken, but what if your car is an extension of your personality? What if you've invested thousands of dollars into making it uniquely yours? I'm talking to the car enthusiasts now. The ones with the custom rims that cost more than a used car. The ones with the booming high-end stereo system that makes the windows shake. The drivers who've added a lift kit, a custom paint job, a specialized camper shell, or performance-enhancing engine modifications. If that's you, you need to listen very, very closely to this next part. You might assume that if your car is damaged or stolen, your insurance will cover all those amazing upgrades you've poured your time and money into. In most cases, you would be wrong. A standard auto policy is designed to cover the car as it left the factory, the stock version. They'll pay to replace your factory stereo, not your $3,000 custom audio setup. They'll pay for standard wheels, not your $5,000 forged alloy rims. All that extra value you added could vanish in an instant. This is where the custom parts and equipment, or CPE endorsement, comes in. This is a specific addition to your policy that increases the coverage for aftermarket parts that weren't installed by the original manufacturer. Think of it like this: your standard comprehensive and collision coverage protects the car itself. The CPE endorsement is a separate bucket of money, specifically set aside to protect your modifications. You typically buy it in increments of $1,000. So, if you've added about $5,000 worth of custom gear to your truck, you would add a $5,000 CPE endorsement. Now, if your truck is stolen, the insurance company won't just look up the Blue Book value for a standard model. They'll pay that value, plus they'll pay up to an additional $5,000 to cover the loss of your lift kit, your oversized tires, your custom grille, and your light bar. If you're in an accident and your custom front bumper and stereo system are destroyed, this coverage pays to repair or replace them with aftermarket equivalents. To get this coverage, you need to be diligent. You must keep your receipts. Take photos of the equipment and the installation. You have to prove the value of what you've added. The insurance company isn't just going to take your word for it that your stereo was worth $5,000. But if you have the documentation, this endorsement ensures that your passion and your investment are actually protected. Without it, all that money is at risk. It's a relatively inexpensive endorsement, but for those who have customized their ride, it is absolutely essential. It's the difference between getting a check that replaces the car you had versus getting a check that only replaces the car you started with. These three endorsements, roadside assistance, rental reimbursement, and custom parts and equipment, are all about bridging the gap between a major crisis and your daily life. They handle the immediate, frustrating, and often expensive consequences of not having your car. They provide a tow, a temporary vehicle, and protection for your personal investment. We've covered protecting the value of your car against depreciation, and we've covered the hassles of being without it. But what about the most important thing inside the car? You and your passengers. What happens when an accident isn't just about bent metal, but about physical injuries? In the next part, we're diving into the endorsements that protect your health, your wallet, and your well-being after a crash, often regardless of who is at fault. This is where insurance gets deeply personal, and it's a topic you absolutely cannot afford to misunderstand. Let's start with the one you've almost certainly seen on your insurance quote: medical payments coverage, or as it's commonly known, MedPay. Think of MedPay as your immediate financial first aid kit after an accident. Its purpose is simple and powerful. It pays for the medical and funeral expenses for you and any passengers in your car who are injured in an accident, regardless of who was at fault. Let that sink in. No waiting for insurance companies to argue for months about who ran the red light. No haggling over liability. If you're hurt in your car, MedPay steps in to cover things like health insurance deductibles, co-pays, ambulance rides, doctor visits, surgery, and even dental work if your teeth are damaged in the crash. Now, the first question everyone asks is, but I have health insurance. Why would I pay for MedPay? It's a fantastic question, and the answer reveals a critical gap in many people's financial safety net. Imagine you have a solid health insurance plan, but it comes with a $5,000 annual deductible. You get into a fender bender, not a terrible one, but you get whiplash and need an emergency room visit, some x-rays, and a few weeks of physical therapy. The bill comes to $4,000. Your health insurance won't pay a dime until you've satisfied that $5,000 deductible. So that entire $4,000 bill is on you. But if you had a $5,000 MedPay endorsement on your auto policy, it would cover that bill dollar for dollar without you ever touching your own savings. It bridges the gap. Even better, MedPay follows you. If you're hit by a car while walking as a pedestrian or riding your bike, your MedPay coverage can often be used to pay for your injuries. It's personal, portable medical coverage for auto-related incidents. It's relatively inexpensive, and for the peace of mind it provides, it can be one of the most valuable endorsements you can add. But in some states, MedPay has a bigger, more powerful sibling: personal injury protection, or PIP. If MedPay is a first aid kit, PIP is the entire ambulance. PIP is a requirement in what are known as no-fault states. In these states, the law says that after an accident, each person's own insurance pays for their initial injuries, up to a certain limit, regardless of who caused the crash. This is designed to speed up payments and keep smaller injury claims out of the court system. And the mechanism for this is PIP. Like MedPay, PIP covers your medical expenses. But that's where the similarities end. PIP goes much, much further. It also covers lost wages. Let's say that whiplash from your accident is severe enough that you can't work for a month. If you're a freelance graphic designer or an Uber driver, that means zero income. PIP can reimburse you for a percentage of that lost income, keeping your bills paid while you recover. This is a game changer. But it doesn't stop there. PIP can also cover what are called replacement services. Imagine you're a stay-at-home parent who breaks a leg in a car accident. You can't do the laundry, you can't clean the house, you can't take care of your kids. PIP can pay for services like a housekeeper or childcare to handle the essential tasks you're now unable to perform. It helps keep your entire life from grinding to a halt because of an injury. In the most tragic cases, it also provides a funeral expense benefit. So the difference is crucial. MedPay is strictly for medical bills. PIP is for medical bills and the economic fallout of an injury, the lost income and the essential services you can no longer perform. If you live in a no-fault state, you're required to have it. If you don't, it's generally not available, and MedPay becomes your best option for this kind of immediate, no questions asked coverage. Now let's shift gears to what might be the single most important endorsement you can buy. It protects you from a threat that's terrifyingly common on American roads: the uninsured driver. The statistics are staggering. Nationwide, roughly 1 in every 8 drivers has no auto insurance. In some states, that number is as high as 1 in 4. Think about that. On your daily commute, you will almost certainly share the road with dozens, if not hundreds, of drivers who have zero ability to pay for the damage they might cause. So what happens if one of them slams into you, and it's clearly their fault? They caused the accident, they totaled your car, and they sent you to the hospital. In a perfect world, their liability insurance would pay for everything. But they don't have any. Your only option is to sue them personally. But let's be honest. Someone driving without insurance is highly unlikely to have thousands of dollars in assets or savings for you to collect. You can win a lawsuit and still get nothing. This is where uninsured motorist coverage, or becomes your superhero. If you are hit by an uninsured driver, this endorsement allows you to make a claim with your own insurance company. Your insurer essentially steps into the shoes of the at-fault driver and pays you what you would have been entitled to collect from them. coverage is typically split into 2 parts. Uninsured motorist bodily injury (UMBI) covers your medical bills, pain and suffering, and lost wages. All the things the other driver's liability coverage should have paid for. Uninsured motorist property damage (UMPD) pays to repair or replace your car. In some states, UMPD is replaced by or combined with collision coverage, but the bodily injury part is the absolute core of this protection. Without it, you could face financial ruin from an accident that wasn't even your fault. But there's a second, more subtle danger. The underinsured driver. This is the person who did the bare minimum. They bought car insurance but only the lowest amount required by state law. In many states, the minimum liability for bodily injury is just $25,000 per person. That might sound like a lot, but one ambulance ride, one night in the emergency room, and one MRI can burn through that limit almost instantly. If you need major surgery and weeks of rehabilitation, your medical bills could easily soar into the hundreds of thousands of dollars. Once that at-fault driver's $25,000 limit is exhausted, their insurance company is done. They won't pay another cent. You're left on the hook for the rest. This is where underinsured motorist coverage, or UIM, saves the day. It covers the gap between the other driver's low liability limit and the actual cost of your injuries, up to the limit you selected for your UIM coverage. So if your medical bills are $100,000, and the at-fault driver only has a $25,000 policy, your UIM coverage could step in to pay the remaining $75,000. It ensures that your recovery isn't limited by the irresponsibility of the person who hit you. When you buy UM/UIM coverage, you'll be asked to choose your limits. The best advice from nearly every expert is to select limits that are at least equal to your own bodily injury liability limits. If you have enough assets that you feel you need $250,000 in liability to protect yourself in case you cause an accident, you should have that same amount of UM/UIM coverage to protect yourself from someone else. You are, in effect, buying protection from the unknown financial status of every other driver on the road. These three endorsements, MedPay, PIP, and UM/UIM, form a powerful shield. They aren't about fixing your car's bumper. They're about rebuilding your life. They ensure that a physical injury doesn't spiral into a devastating financial one. They protect your health, your ability to earn an income, and your family's stability. While we all hope we never have to use them, the reality of the road means that ignoring them is a gamble you can't afford to take. But protecting yourself is only half the battle. What about protecting the value of your vehicle itself, especially when it's brand new or heavily customized? That new car smell. It's more than just a scent. It's the smell of a fresh start, a major life achievement. You sign the papers, grab the keys, and drive off the lot feeling like you're on top of the world. But in that exact moment, a silent financial process kicks into gear, one that can turn your dream purchase into a financial nightmare: depreciation. The second your tires hit public pavement, your brand new car is no longer brand new. Its value plummets. We're not talking a few dollars. Some models can lose 10, even 20% of their value in the first year alone. Now you might think, so what? I plan on driving this car for years. And that's a great plan. But accidents don't follow plans. Let's imagine the unthinkable happens just a few months after you buy your new ride. You're involved in a serious collision, and the insurance adjuster declares your car a total loss. It's heartbreaking, but at least you have insurance, right? They'll pay it off and you can start over. Not so fast. This is where thousands of Americans get a brutal lesson in something called actual cash value. Your insurance company isn't going to pay you what you paid for the car. They're not going to pay off your loan balance. They are going to pay you what the car was worth the second before the crash. That's its actual cash value, or ACV, and it includes that massive chunk of depreciation. Suddenly, you're facing a terrifying financial gap. Let's put some real numbers on this. Say you bought a new SUV for $40,000. You made a modest down payment of $2,000 and financed the remaining $38,000. 6 months later, it's totaled. You've made a few payments and you still owe about $36,500 on your loan. But because of depreciation, the insurance company determines the car's actual cash value is only $30,000. They write you a check for $30,000 minus your $500 deductible, so you get $29,500. You see the problem? You have a check for $29,500 in your hand, but you still owe the bank $36,500. You are now $6,000 in debt for a vehicle that exists only as a twisted wreck in a salvage yard. You have no car, and you have to keep making monthly payments on a ghost, all while trying to figure out how to afford a down payment on a replacement vehicle. This is the gap. And it's a financial trap that can cripple you. This is precisely why one of the most critical endorsements for any new car owner exists: loan/lease payoff coverage, more famously known as gap insurance. Gap insurance is the hero of this story. It's an endorsement you add to your policy that is specifically designed to cover the difference, the gap, between the actual cash value of your vehicle and the amount you still owe on your loan or lease. In our example, that $6,000 difference that would have come out of your pocket, gap insurance pays for it, settles the loan. It wipes the slate clean, freeing you from a crushing debt and allowing you to focus on getting back on the road. Now, you might have heard of gap insurance at the dealership. The finance manager probably offered it to you in a high-pressure pitch while you were signing your life away. And while their product does the same thing, buying it as an endorsement directly from your auto insurance provider is almost always significantly cheaper. We're talking a few extra dollars on your monthly premium versus being rolled into your car loan, where you pay interest on it for years. Who needs this? If you put down less than 20% on your new car, you almost certainly need it. If you finance for 60 months or longer, the loan will amortize slower than the car depreciates, creating a gap. You need it. If you rolled negative equity, that is, debt from your old car loan into your new loan, you absolutely 100% need it. And if you're leasing a vehicle, it's often required, and for good reason. You're essentially paying for the car's depreciation, and a total loss could leave you on the hook for a massive bill. Gap insurance isn't just an add-on. For millions of drivers, it's an essential financial shield against the brutal reality of depreciation. But the value of a car isn't just about what it's worth on paper when it's new. For many of us, our car is a canvas. It's a reflection of our personality, our passion. We don't just drive a stock vehicle. We enhance it. We build it. We pour our time, our sweat, and our hard-earned money into making it uniquely ours. We're talking about the truck owner who adds a $10,000 lift kit, monster tires, and custom lighting. The enthusiast who installs a $5,000 high-performance engine and a state-of-the-art sound system. The artist who pays for a one-of-a-kind $20,000 custom paint job. These customizations add immense personal and real-world value to the vehicle. But here's a terrifying secret hidden in the fine print of a standard auto policy. Most of it isn't covered. Your standard comprehensive and collision coverage is designed to repair or replace your car with factory-equivalent parts. That's it. If your truck with that $10,000 lift kit is stolen, the insurance company will value it as a stock truck. They won't give you a dime for the lift kit, the wheels, or the custom bumper. All that money, all that passion gone. Vanished. Imagine pouring $30,000 into restoring and modifying your dream car, only to have it totaled and be offered a check for the $12,000 book value of a stock model. The financial devastation is matched only by the emotional gut punch. This is where another powerhouse endorsement comes into play. Custom Parts and Equipment Coverage, or CPE. CPE coverage is your declaration to the insurance company that your vehicle is more than stock. It's an endorsement that extends your comprehensive and collision coverage to protect the investments you've made in your vehicle. It covers the things that are permanently installed or attached to your car. Think about those beautiful, expensive aftermarket wheels and tires, the booming subwoofer and amplifier built into your trunk, the custom grille, the spoilers, the running boards, the specialized equipment for mobility like a wheelchair lift, even that incredible wrap or custom paint job. Here's how it works. When you add CPE coverage, you and your insurer agree on a specific dollar amount of additional coverage, say $5,000, $10,000, or even more, on top of your car's regular value. This becomes the new limit for what they will pay out for your car, and its modifications in the event of a covered claim. So if your car with $10,000 in custom parts is totaled, your CPE coverage ensures you get compensated for that investment, not just the car's base value. But there is a critical, non-negotiable rule you must follow for this to work. Documentation. You must prove the value of your custom parts. This means keeping every single receipt. Take detailed photos of the parts before and after installation. Keep a log of the work done, including labor costs. If you have extremely valuable or unique modifications, it might even be worth getting a professional appraisal. When it comes time to file a claim, this binder of proof is your golden ticket. Without it, you're just arguing with an adjuster, and that's a battle you are unlikely to win. Both gap insurance and custom parts and equipment coverage serve the same fundamental purpose. They close the dangerous gap between what a standard insurance policy thinks your car is worth and what your car is actually worth to you financially. One protects you from the inescapable math of depreciation on a new loan. The other protects the tangible value you've personally added, piece by piece. Ignoring them is like building a beautiful house but refusing to insure its true value. You're not just risking the car, you're risking your entire financial stability. These endorsements aren't just about covering a vehicle, they're about honoring your investment and safeguarding your future. They transform your policy from a generic safety net into a tailored suit of armor, built specifically for your financial situation. But once the accident is over, once the value of the car has been settled, a whole new set of problems begins. Your car is gone, either temporarily in a repair shop or permanently in a salvage yard. How do you get to work tomorrow? How do you pick up your kids from school? The immediate aftermath of an accident is a logistical nightmare, and without the right preparation, the chaos is just beginning. This is where a tiny detail on your policy, an endorsement that costs less than a weekly coffee, becomes the most important line item you've ever paid for. It's the difference between a manageable inconvenience and a full-blown life crisis. Let's talk about the unsung hero of post-accident logistics: rental reimbursement coverage. Imagine two drivers, Sarah and Tom. They have identical cars, identical accidents on the same day. Both cars are towed away, needing at least 2 weeks of repairs. Both of them have comprehensive and collision coverage, so the repair bill itself is handled, minus their deductible. But their experiences over the next 14 days will be a world apart. Sarah does not have rental reimbursement. The morning after the accident, the reality hits her like a ton of bricks. Her commute is 45 minutes. An Uber is going to cost her $60 one way. That's $120 a day. Over 2 weeks just to get to and from work, she's looking at over $1,000 out of pocket. That's on top of her $500 deductible. Suddenly, that single accident is costing her $1,500 in cash. Right now, she tries to coordinate carpooling, but schedules don't line up. She begs her brother to borrow his car, but he needs it. She's late for work twice in the first week, stressed and constantly scrambling. The accident wasn't just a financial hit. It's a thief stealing her time, her peace of mind, and her productivity. Now let's look at Tom. Tom pays an extra, let's say $5 a month for a rental reimbursement endorsement. The morning after his accident, he makes one phone call. Not to beg a friend for a ride, but to his insurance company. They confirm his coverage and connect him directly with a major rental car agency they partner with. He takes an Uber to the rental office, a single one-time expense, and picks up a mid-sized sedan. His life continues. He gets to work on time. He picks up his groceries. He takes his kids to soccer practice. The biggest inconvenience is remembering which car he's driving. His total out-of-pocket cost for transportation during those 2 weeks? $0. The insurance company pays the rental agency directly. For the price of a single fast food value meal each month, Tom completely bypassed the logistical nightmare that consumed Sarah's life. That is the power of an endorsement. It's not about the big dramatic crash. It's about managing the fallout. So what does this coverage actually look like on your policy? You'll typically see it written as a set of 2 numbers, like 30/900 or 50/1500. This isn't confusing insurance code. It's actually very simple. The first number is the maximum amount the policy will pay per day for a rental car. In the 30/900 example, that's $30 per day. The second number is the total maximum the policy will pay for a single claim. In this case, $900. So $30 a day for a maximum of 30 days, because 30 times 30 is 900. If you have 50/1500, it means $50 a day for a maximum of 30 days. The key is understanding what that daily limit gets you. $30 a day might only cover a basic economy car. If you drive a large SUV to haul your family around, you might want to opt for a higher daily limit, like $50 or $75, to ensure you can rent a comparable vehicle without paying the difference out of your own pocket. A few crucial things to remember. This coverage only kicks in for a covered loss. If you just need a rental because your car is in the shop for routine maintenance or a mechanical breakdown, this won't apply. It has to be tied to a claim that your policy is paying for, like an accident covered by collision or a theft covered by comprehensive. Also, it doesn't cover the extras. Things like gasoline for the rental, or the extra insurance the rental company tries to sell you at the counter, are on you. But the core cost of having wheels while yours are out of commission? It's covered. Now, rental reimbursement solves the problem of after your car is at the shop. But what about the moment right after the crash? You're on the side of a busy highway, metal is bent, fluids are leaking. You can't just leave your car there. You need a tow. And if you've ever had to pay for a tow out of pocket, you know the sticker shock is real. A simple tow of a few miles can easily cost $100, $200, even $300 or more, especially if it's late at night or in a remote area. This is where another incredibly valuable and incredibly cheap endorsement comes into play: towing and labor coverage. Think of this as your roadside guardian angel. It's typically sold with different levels of coverage, say up to $50, $75, or $100 per disablement. When your car is undrivable due to a covered incident, this endorsement steps in to pay for the tow to the nearest qualified repair facility. It's not just for accidents either. Unlike rental reimbursement, this coverage often applies to simple breakdowns. Car won't start? Flat tire? Locked your keys in the car? This endorsement can often cover the service call. The labor part of towing and labor can be a bit confusing. It does not mean it pays for the mechanic to fix your engine at the shop. It refers to the labor that happens right there on the side of the road. For example, the cost for the service technician to spend 30 minutes changing your flat tire, jump-starting your battery, or trying to unlock your door. The endorsement covers that immediate on-site labor. Just like rental reimbursement, the cost for this peace of mind is astonishingly low, often just a few dollars a month. When you weigh that against the sudden, unexpected, and often inflated cost of a single tow truck call, the math is overwhelmingly in your favor. Having this coverage means that in a moment of high stress, stranded on the roadside, you're not also having a financial panic attack, wondering how you're going to pay the driver who just showed up. You make a call to your insurance company's roadside assistance line, and they dispatch and pay for the service directly. It turns a potential crisis into a simple phone call. So we've now solved the immediate problems. Your car is being towed to a shop and you have a rental car to get you around. The logistical chaos has been contained. You've successfully navigated the first 24 hours thanks to 2 simple, inexpensive endorsements. You feel a sense of relief. You think the worst is over. But the biggest financial threat of the entire ordeal hasn't even revealed itself yet. It's a threat that has nothing to do with your car or your rental. It has everything to do with the person who hit you. What if the police report comes back and the other driver has no insurance at all? Or what if they have the absolute bare minimum coverage required by the state, and your medical bills are already 10 times that amount? You've solved the problem of your property, but the threat to your health, your savings, and your financial future is a ticking time bomb you don't even see yet. This is the moment where a simple car accident spirals into a life-altering financial catastrophe. Because while your collision coverage is busy getting you a check for your crumpled fender, the ambulance bill alone could wipe out your emergency fund. And that's just the beginning. The emergency room visit, the x-rays, the specialist consultations, the follow-up physical therapy. It's a tidal wave of debt, and it's heading straight for you. The other driver's insurance? Maybe they'll pay. Eventually. After months of fighting, arguing, and proving that every single dollar was necessary. But your bills are due now. Your landlord doesn't care about their claims process. Your mortgage company won't wait. This is the hidden danger of focusing only on the car. We spend so much time protecting the metal, the glass, and the plastic that we forget to protect the most valuable thing in the car, ourselves. And that is where the second, and arguably far more important, category of endorsements comes into play. These aren't about fixing your property. These are about fixing you. They are the financial lifeboats that keep you from drowning in medical debt and lost income after an accident. Let's start with the most basic one. Medical payments coverage, often called MedPay. Think of MedPay as a small, dedicated health insurance policy just for car accidents. It's designed to pay for your immediate medical expenses and those of your passengers right away with no finger pointing. The most critical phrase here is regardless of who is at fault. If you rear-end someone and your head hits the steering wheel, MedPay can cover your emergency room copay. If a friend is riding with you and they sprain their wrist in a minor fender bender, MedPay can cover their x-ray. It covers things like health insurance deductibles, ambulance fees, dental work if you chip a tooth, and in the worst-case scenario, even funeral expenses. It's typically sold in smaller amounts, maybe $1, $5, or $10,000. It's not meant to cover a catastrophic injury, but it's a powerful tool for handling the immediate, out-of-pocket costs of a minor to moderate accident without having to dip into your savings or wait for a settlement. It's the fast-acting pain reliever for the financial headache that follows a crash. But what if the injury isn't minor? What if it's serious enough to keep you out of work? This is where MedPay's bigger, more powerful cousin steps in: personal injury protection, or PIP. In some states, known as no-fault states, pay is mandatory. In others, it's an optional endorsement, and it is one of the single most important you can consider. Because PIP doesn't just cover your medical bills like MedPay does. It covers the one thing that can destroy a family's finances faster than almost anything else: lost wages. Let's imagine you're a freelance graphic designer, an Uber driver, or a construction worker. You get paid when you work. If you don't work, you don't get paid. Now, picture being in an accident that wasn't your fault. You suffer a broken leg and a concussion. The doctors say you can't work for 2 months. Your medical bills are piling up. But the immediate terrifying problem is that your income has just dropped to zero. The other driver's insurance company is investigating the claim. They might pay you eventually, but your rent is due next week. This is the exact scenario PIP was designed to prevent. Personal injury protection steps in and pays for your medical bills, just like MedPay, but it also replaces a percentage of your lost income while you recover. It can even cover essential services, like paying for someone to clean your house or provide childcare if your injuries prevent you from doing it yourself. Pays you from your insurance company right away. No waiting for the other driver's company to admit fault. It is the ultimate financial safety net that catches you the second you fall. It ensures that a physical injury doesn't immediately become a full-blown financial crisis, giving you the breathing room to heal without the crushing stress of watching your bank account drain to zero. Now we have to talk about the elephant in the room, the scenario that every driver secretly fears. What happens when the person who crashes into you has no insurance at all, or they have the absolute bare minimum coverage that barely pays for a fraction of the damage they've caused? According to the Insurance Research Council, a staggering 1 in 8 drivers on the road in the United States is uninsured. That's more than 30 million people driving around with no way to pay for the damage they might cause. This is not a rare event. It is a statistical probability. This is where you need the knight in shining armor of endorsements: uninsured and underinsured motorist coverage. Let's break that down. Uninsured motorist coverage, or UM, protects you when you're hit by someone with zero insurance. It essentially steps into the shoes of the at-fault driver's insurance that doesn't exist. Your insurance company pays you for your medical bills and, depending on the state, for the repairs to your car, just as if the other driver had a good policy. It prevents you from being punished for someone else's irresponsibility. But the second part is just as crucial. Underinsured motorist coverage, or UIM. This protects you from a far more common problem. The other driver has insurance, but their policy limits are ridiculously low. Let's say your state only requires drivers to carry $25,000 in bodily injury liability coverage. You're in a serious accident caused by one of these drivers. You need surgery, you're in the hospital for a week, and you have months of physical therapy ahead. Your total medical bills climb to $150,000. That other driver's policy pays out its maximum of $25,000. And then that's it. They're done. You are now personally on the hook for the remaining $125,000. Your life savings, your retirement accounts, the equity in your home, it's all at risk. Unless you have underinsured motorist coverage. With UIM, once the other driver's paltry insurance is exhausted, your own policy kicks in and covers the rest, all the way up to the limits you chose. If you have $250,000 in UIM coverage, it would pay that remaining $125,000 bill in full. It is the only thing standing between you and potential bankruptcy because of another person's poor decisions. Let this sink in. Collision and comprehensive fix your car. They are about property. But MedPay, PIP, and uninsured/underinsured motorist coverage, they fix you. They protect your body, your health, your ability to earn an income, and your entire financial future. They are the endorsements that truly matter because a car is replaceable, but your life and your financial stability are not. We've now covered the endorsements that protect your property and the ones that protect your person. We've seen how these small, often inexpensive, additions to your policy can be the difference between a bad day and a ruined life. But now we arrive at the most practical and most important question of all. How do you get the right ones for the right price? How do you navigate the conversation with your agent to build a truly bulletproof policy without paying for things you don't need? That's where we pull back the curtain and put all this knowledge into action. Here's the playbook. This is the step-by-step guide to transforming your car insurance from a confusing monthly bill into a fortress of financial security. First, before you even think about picking up the phone to call your agent, you need to do a personal audit. This is non-negotiable. Walking into that conversation unprepared is like walking into a final exam without studying. You're at the mercy of whatever the other person tells you. So grab a piece of paper or open a new note on your phone. We're going to build your profile. Category 1, your vehicle. Write down the make, model, and year. But more importantly, what's its real-world value? Go to Kelley Blue Book or a similar site and get a realistic private party sale value. Is it a 10-year-old sedan worth $3,000? Or a 2-year-old SUV worth $40,000? This number is your anchor for deciding on things like collision and comprehensive coverage. Paying for full coverage on a car that's worth less than your deductible and a year's worth of premiums is just throwing money away. Next, do you have a loan or a lease? If the answer is yes, you must write down gap insurance as a major talking point. You are almost certainly required by your lender to have it, And if you don't, you're playing with fire. Category 2. Your driving habits. Be brutally honest with yourself. How many miles do you drive a year? Is it a short commute to a local office, or are you a road warrior clocking 25,000 miles a year? The more you're on the road, the higher your risk, and the more robust your coverage needs to be. Do you drive for a rideshare service like Uber or Lyft? Or deliver for DoorDash? Even one trip a week means your personal policy is void while you're working. You absolutely need a rideshare endorsement. Write that down. Where do you park? In a secure private garage or on a busy city street known for break-ins and hit-and-runs? This directly impacts your need for comprehensive coverage. Category 3. Your financial picture. This is the part people skip, and it's the most critical. What is your net worth? You don't need a forensic accountant, just a ballpark. Add up your assets, your savings, investments, the equity in your home. Now, look at your policy's bodily injury and property damage liability limits. If your liability limits are $50,000, but you have $200,000 in assets, what do you think happens in a major at-fault accident where the damages exceed your coverage? They come for your assets. They can garnish your wages, put a lien on your house, they can ruin you. Your liability limits should, at a bare minimum, protect your net worth. This is where you write down increased liability limits, or ask about an umbrella policy. Also, what's in your emergency fund? Can you comfortably afford a $500 deductible? $1,000? $2,000? A higher deductible lowers your premium, but if you can't pay it when you need to, it's useless. Now you have your audit. You have your talking points. You are armed with knowledge. It's time to make the call. When you get your agent on the line, you are not a passive customer. You are a partner in crafting your protection. You lead the conversation. Start with confidence. Hi, I'm calling to do a comprehensive review of my auto policy. I've assessed my needs and I want to make sure my coverage, especially my endorsements, are aligned with my situation. This single sentence changes the entire dynamic. You've just told them you're an educated consumer, not an easy upsell. Now you walk through your audit. Let's start with my vehicle. It's a 2018 model, and I see its current value is around $20,000, but I still owe $24,000 on the loan. I want to confirm I have gap coverage, and I want to understand what the premium is for that specific endorsement. Next, my driving. I've recently started driving for Uber on weekends. I need to add a rideshare endorsement to my policy. Can you tell me what that costs and what exactly it covers? Now let's talk about liability. I've calculated my assets and I'm concerned my current state minimum limits are nowhere near high enough. Let's model out the cost of increasing my bodily injury liability to $250/500 and my property damage to $100. And while we're at it, can you quote me an umbrella policy for $1 million? I want to see the price difference and understand the value. You see what's happening here? You are directing the flow. You are asking specific, intelligent questions based on your own research. You're not asking, what do you think I need? You're saying, this is my situation. Let's discuss the best tools for the job. As they present options, your job is to ask why. If they suggest an endorsement you haven't heard of, like OEM parts coverage, don't just nod along. Ask, my car is 5 years old. How much more would an OEM part cost versus a quality aftermarket part in a typical repair? And how does that compare to the annual cost of this endorsement? You're doing a cost-benefit analysis in real time. This is also the moment to talk about saving money. The best defense is a good offense. Ask directly. Now that we've tailored the coverage, let's talk about price. What discounts am I currently getting? And are there any I'm eligible for that haven't been applied? Maybe you took a defensive driving course or your kid is getting good grades in school. Maybe your car has anti-theft features you never mentioned. Every discount matters. And don't forget the magic of bundling. I also have my homeowner's insurance with another company. Could you run a quote to see what I would save by bundling my home and auto policies with you? I need to see the full picture, apples to apples. Sometimes the multi-policy discount is so significant, it can pay for several of the endorsements you just added. But never ever be afraid to walk. Loyalty is a two-way street. After you have your ideal, bulletproof policy quoted by your current insurer, take that exact quote, same coverages, same deductibles, same endorsements, and get quotes from at least 2 other reputable companies. You might find that your loyal provider is charging you hundreds of dollars more per year for the exact same suit of armor. A 10-minute online quote or a 15-minute phone call could save you enough money to fully fund your emergency deductible. Finally, Understand that this is not a one-time event. Your life is not static. Your insurance policy shouldn't be either. You must schedule an annual policy review in your calendar, just like a doctor's checkup. Did you get a raise and your net worth increased? You might need to up your liability limits. Did you just pay off your car loan? It's time to drop the gap insurance and maybe reconsider your need for high-cost collision coverage. Did your teenager just get their license? That is a massive change that requires an immediate call to your agent. Treating your insurance policy as a living document that evolves with your life is the single biggest secret to being permanently and properly insured without overpaying. So, what is a car insurance endorsement? It's not just an add-on. It's not just a box to check. It's a tool. It's a scalpel that allows you to carve out a policy that fits the unique contours of your life. It's the difference between a generic off-the-rack t-shirt and a custom-tailored suit. One just covers you. The other is designed for you, protects you perfectly, and gives you the confidence to walk through the world knowing you're prepared. You now know more about this topic than 99% of drivers on the road. But knowledge is only potential power. Action is real power. Your mission, should you choose to accept it, is to stop being a passive passenger in your own financial life. Pull out your current insurance policy declaration page. Find just one thing, one endorsement you think you need, or one limit you think is too low. Circle it. Tomorrow, make the call. Take control. You are the CEO of your own protection. It's time to start acting like it.